let me just erase this first. All right, guys. So we are going to talk about the last portion of this chapter, which are the determination of variance analysis, or determination of variances, aka variance analysis. Guys, variance analysis, very simple. Let me just talk about this. It is to estimating the difference between actual outcome and the budgeted outcome. We are going to compare the actual results with the standard/budgeted results of revenue expense items, and then we're going to come up with decision-making analysis. We are going to the managers utilize this to identify the causes of difference. For example, if labor cost or labor expense is too much off from the standard, hey, is the price the issue? Is the price the issue, or the working hour standard is the issue? The number of employees hired temporarily? What is the issue? Variance analysis answers these questions, and of course, assess the operational performance, and then come up with the problematic areas, and come up with a further strategical analysis or strategical decision-making process to cover up, to fix the problems, okay? So it's a very, very useful tool for hospitality decision makers, and then they utilize this, again, to compare the actual results with the budgeted results to come up with the strategies and to analyze the problems and to fix the problems, okay? Guys, there are two different variance expressions over here we're going to talk about. First one is dollar variance, very easy. We have, let's say, $10,000 actual revenues versus $9,000 budgeted, and the difference will become $1,000, okay? So we have $1,000 difference, and this is the dollar variance over here. Or we have the relative variances or percentage variance. We know how to do this, okay? Relative variance is also called as the percentage variance. We are going to determine this by dividing the dollar difference by the budgeted dollar amount. So as we know right now, current value minus previous value over previous value, this is the difference I'm talking about. So difference over previous value is going to give us 11.11% based on this example right here. Therefore, 1,000 over 9,000 will be equal to 11.11%, and this will become the percentage variance, percentage change, or the relative variance or relative change. Keep that in mind. I might use those terms interchangeably, guys. Okay, so our variance analysis will be based on both the dollar variance and the relative variance, and we are gonna see examples in a second, and then we are gonna analyze them both. Okay, guys, keep that in mind. Please understand them, and then let's just proceed with some more details. Guys, dollar variance and percentage variance, they should be utilized jointly. Why? Because it will make much more sense. Remember the advertising expense that we did in the trend analysis. Sometimes dollar variance might not show a trend or might not tell you much, but the percentage difference might tell you a lot. Therefore, dollar difference and the percentage difference will be and should be analyzed jointly in budgeting process to create budgets, to come up with the budgets, and to assess the operational performance, guys. All right. Oh God. Okay. What's 1 second? All right. The effect of both variances on budgets will be, of course, different than each other. That's why it has to be analyzed differently. Guys, variances for both revenue expenses should be determined with an indication. What are the indications? Indications are either UF, which is unfavorable, okay, or F, which is favorable, okay? Favorable variance for both and expenses, that's what you want as a decision maker, because that means you're in a positive side when you compare your budget with the actual. Unfavorable means that, unfortunately, whatever you're analyzing, whatever the variance is, produces unfavorable results that pushes you back, sets you back. That means that you have to go back, analyze it correctly, and then fix what causes the unfavorable condition. Therefore, favorable, unfavorable conditions are very important. We are going to come up with the judgment. Our interpretation will be based on, hey, look, I have favorable revenue levels when I compare my budgets or budgets and the actual results. Or I have unfavorable results when I compare my budgets with the actual results. In order for us to determine, we have to follow a rule of thumb, guys, which is very, very, very important. Why? The entire operational judgment will be based on this little table right here. I call this is your Bible for the variance analysis, guys, okay? This is the Bible for variance analysis. I just like to change my marker. Let me just draw a line over here because I'm going to talk about them separately. For revenues, if actual exceeds budget, it will produce favorable variance. That's what you want. Remember, you always want, for both expenses and revenues, you always want favorable variances. However, if budget exceeds the actual, it will create negative values, meaning it will produce unfavorable results. This is for revenues. For expenses, it is the other side of the coin. We're going to talk about the other side of the coin right now. If budgeted exceeds the actual, that's what you want as a favorable result. However, if actual exceeds the budget, it will produce unfavorable results. But look, this for expenses, actual exceeds budgets, actual exceeds budgets. For revenues, it is favorable, but for expenses, it is unfavorable, of course. If the actual exceeds budgets, for example, you spend $10 for an item when you budget $8, this is negative $2. That means you are at the unfavorable condition. That's exactly what I'm talking about. So when you are self-studying by yourself, guys, please make sure you understand the entire table, because it is your Bible to determine the variances, to come up with a healthy, financially healthy judgment in the operation. Okay, guys? Please make sure you understand this, because when I show you in class exercise right now, we are going to be incorporating all these conditions, all these rule of thumb in our exercises, and then we are going to interpret the results we have to see if you're on the favorable side or the unfavorable side. Okay, guys? Please keep that in mind. All right. Okay. That's exactly what I talk about right now. Okay, you can read back. So that's exactly what we talk about right now. Okay. So we're gonna start with the revenue variances. Okay, what we're gonna do, guys? Let me just tell this what I'm gonna tell you right now, and then I will proceed. We're gonna analyze the revenue variances and expense variances separately. So for revenue variances, okay, it occurs because of the price-volume differences in the operations. Okay, price variance is difference between the actual cost of a unit and the budgeted / standard cost of a unit. Volume variances is a difference between the actual and the budgeted sales quantity. Okay. Therefore, what we're going to do, okay, our focus will be on the price and volume differences for the revenue variance analysis, and then we are going to calculate 4 different things over here. We are going to calculate the revenue budget variance, in short BV. We are going to calculate the price variance, in short PV. We are going to calculate the volume variance, in short VV. It might sound a little funny, but that's how it is. And we're going to calculate the price-volume difference. We're going to combine the price-volume difference, because revenue variance is determined by the price and volume variance differences. And we're going to combine them together. We're going to find PVV, and then we're gonna make some judgments based on what we have here. So this is, let me just erase this. This right here, guys, is the full revenue variance analysis. We're going to perform the full variance analysis in the example over here. Our example is the foggy in example. Okay. If the variance increases operating revenue, the variance will be favorable. If it decreases, the variance will be unfavorable. As I told you guys before when I showed you the table, you want to be at the favorable side. You want your operations to produce favorable conditions for both revenues and expenses. Take a look at this example. Take a look at the foggy example, and then let's read it first, analyze it, understand it, and then we will proceed further. The management of Foggy Inn wishes to compare the actual results with the budgeted risk figures for room revenues in April 2012. The operational data is shown in the table like that. So what they want to do, they would like to compare the actual results and the budgeted results, and they would like to come up with the analysis. So they have budgeted results over here, actual results over here, okay? Room nights, 400, they budget 400 room nights, number of rooms sold. But actually they produced 450. ADR, they budgeted $100 ADR, but it was 90. Room revenue is therefore $40,000 versus $40,500. So what we're going to do, based on this table right now, guys, okay, based on this table, we are going to perform a complete revenue variance analysis for Foggy Inn in 2012. How are we going to do this? Let's go back again. We are going to find out, okay, let me tell you this. If any question asks you to find out or asks you to perform a complete revenue variance analysis or COGS variance analysis or labor variance analysis, you have to do this. BV, PV, VV, PVV, meaning you have to calculate 4 different stuff in that specific variance analysis. So for revenues, what we're going to do, we're going to calculate BV, PV, VV, and the combined PVV. So guys, let me show you the solution right here. Revenue budget variance, in short, BV is difference between the actual and the budgeted figure. Therefore, BV is equal to actual revenue minus budgeted revenue. I'm going to go back to my table, okay, because the ultimate source for the numbers is my table. I'm going to go back to my table right here, okay. I'm going to take 4,500 minus $40,500 minus $40,000. I will have $500. But what is that $500? Take a look at this, guys. Let me just read the explanation, because explanations are very, very, very important, okay? So, since $500 revenue variance is more than what Foggy Inn budgeted, its room revenue increases by $500. Therefore, since the variance increases the room revenue, it is a favorable condition. Remember, actual is more than the budget. In other words, actual exceeds the budget. What we're going to do, we're going to go back to our Bible table. If actual exceeds the budget, this is the case in the Foggy Inn example, it will produce favorable results. Let's go back to the solution right here, guys, and boom. Since the 500 revenue variance is more than what Foggy Inn budgeted, okay, which is the difference, we will label this as a favorable condition for the budget variance in revenues, okay. So for PV, we have to take the budgeted volume, multiply it by actual price and the budgeted price. These are the ADR, guys, okay, these are the ADRs. Or you can use the short version of the equation, just like here. Therefore, we budgeted 400 room nights, okay, multiplied by, in parentheses, $90 of ADR minus $100 of ADR, negative $4,000, which produces unfavorable conditions. Why? Because actual ADR is $10 less than the budget ADR. If budget exceeds the actual, it will produce unfavorable conditions for the revenues. If budget, $100, exceeds the actual, which is $90, it will produce unfavorable results. This is how are we going to so this is how we're going to analyze the variances, and then this is how we're going to interpret the results based on the produced results, guys. It produced numerical values, okay? So please make sure you do the same. How I decide this, again, I'm going to go back to my table. I'm going to understand the table over here, and I'm going to decide if there's a favorable or unfavorable condition for both revenues and expenses, okay? Based on this table right here, guys, all right? Please keep that in mind. That's exactly what I'm doing right now. So we calculated so far BV in the room revenue and PV in the room revenue. We still have to calculate VV and the PVV, okay? Guys, VV is equal to budgeted price multiplied by actual volume minus budget volume. You can use the short version over here, okay? Budgeted price, it was the budget ADR, $100, actual volume $450, budget volume $400. Look, actual exceeds budget. If for revenues, actual exceeds budget, it will produce the favorable conditions. By how much? By $5,000. How do we know that? Because we just run the equation, we calculate the $5,000. What is $5,000? Favorable. Why? Because actual exceeds the budget. How much? It produced favorable condition. How much? $5,000. Okay? This is exactly what I'm talking about in my explanations right here. This is how you should also analyze when you're dealing with the variance analysis, guys. All right? And the last one, PVV, okay, we're going to see the price and volume combination, and then we're going to analyze the variances, sorry. PVV is equal to actual price minus budgeted price multiplied by actual volume minus budgeted volume, okay? In short, PVV is equal to AP minus BP multiplied by AV minus BV. These are the short versions. You can also use that as well. So I'm just going to plug in the numbers right here. When I plug in the numbers, guys, okay, let me show you. When I plug in the numbers, okay, actual price 90, budgeted price 100. These are the ADRs. 450 minus 400. These are the sales volumes, room nights. I will produce negative 500. Well, negative 500. What is negative 500? Guys, in order for me to determine unfavorable or favorable for the combined variances, I will have to I will have to follow the interrelationship of the volume and price variances, and then my judgment will be set. So, if it is unfavorable, which is our case, when one of the variances between PV and VV is favorable and the other one is unfavorable. So if one of them is unfavorable, let's say PV, in this case we have unfavorable PV, okay, and then we have favorable VV. Therefore, in this case PV is unfavorable and VV is favorable, okay. Therefore, the interrelationship of price and volume tells us that for judgment purposes, it is unfavorable when one of the variances between PV and VV is favorable and the other one is unfavorable. This is the condition. Therefore, we have the unfavorable result, okay. So in this case, VV is favorable, PV is unfavorable for foggy, and therefore we have the interrelationship of PV and VV tells us that we have an unfavorable condition of $500. On the contrary, either both variances were favorable or unfavorable, then PVV would be favorable. So if, let's say, PV was favorable as well, PVV will produce favorable results. So again, for the combined variances, we always take a look at the interrelationship of individual variances. In this case, which means for the revenues, we're going to take a look at PV and VV, and then based on their condition, we will decide the interrelationship, and then we will proceed, and then our judgment will be finalized. So this is what we're going to do for the expenses as well, guys. Okay, so I just took my time a little bit to deliver the content, but this is exactly what we're going to do for the expenses as well. For the expenses, first one, we have two expenses. First one is the cost of goods sold, guys. Cost of goods sold occurs because of cost and volume differences, okay? Cost variance is difference between the actual amount paid for the cost of goods sold and the budgeted amount, and the volume difference is the total cost of amount minus the budgeted cost amount, okay? So we are going to analyze this based on the costs and the volume differences. When we are analyzing the variances in cost of goods sold, we have to take a look at four different stuff again. Just like revenues, we're going to find out the cost of goods sold variance, COGSV. We're going to find out CV, which is the cost variance, and then we're going to find out VV, which is the volume variance, and then we're going to combine them, and we will find out cost and volume variances simultaneously on a combined level, and then we will analyze the cost of goods sold, budget and actual differences, which is the variance, okay? Again, don't forget, if the variance, I'm talking about this part right now, if the variance increase operating cost of goods sold, the variance is unfavorable. Of course, you don't want your cost of goods sold to increase, that's why it's unfavorable, and vice versa, okay? Maniel Restaurant is the case right now. We are going to analyze Maniel Restaurant. Recently obtained actual cost figures for its food operations, and the management would like to compare these figures with the budgeted cost figures based on the cost data. So this is our cost data. What we're going to do, guys, we are going to perform a complete COGS variance analysis for Maniel. We're going to find COGS V, CV, VV, and CVV. We're going to find out 4 different stuff for Maniel Restaurant. Take a look at my solution. Again, let me tell you this. Hang on, let me just clear the table first. I mean the screen first. Let me tell you this. Whatever I do in my solution, my ultimate source will be this table, guys, okay? COGS is the difference between the actual and the budget figure. Therefore, COGS is equal to actual cost minus budget cost. My actual cost is $13,120 and my budgeted cost is $12,000. Okay? So the difference is $1,120, $1,120. Question. Unfavorable? Favorable? Which one? Okay? Since $1,120 variance is more than what Maniel budgeted, if actual exceeds the budget for expenses, it will produce unfavorable results. By how much? By $1,120. That's why we have the unfavorable condition for Maniel Restaurant. So it is the opposite of revenue variances right now. Okay? Keep that in mind. Again, if you don't remember how I remember, you always go back to the Bible table. You always go back to the Bible. Take a look at the conditions and then analyze if it's favorable or unfavorable, guys, okay? So please don't forget. So how about the CV right here? The CV, take a look at this. CV is equal to budgeted volume multiplied by budgeted cost per unit minus actual cost per unit, okay? Budgeted volume is 3,000, budgeted cost per unit $4, and the actual is 4.10. When I do the math, it is also negative 300. Oh, let me tell you something. It is not always the case that negative 100 will produce unfavorable results, or negative 300 will produce unfavorable results for both revenues and expenses automatically. Why? Take a look at over here. Okay, that is exactly why you have to discuss and analyze the condition based on the table, based on the Bible, and then decide if it's favorable or unfavorable. Take a look. Yes, we have negative $300 over here, but it's unfavorable, but not just because of it is a negative 300. That's why we have unfavorable results, because actual exceeds the budget again for CV by $4.10. Therefore, in total, we have $300 unfavorable balance or unfavorable result for the cost variance. Okay. How about the VV? How about the volume variance? This is the equation for VV. Budgeted cost per unit is $4. Budgeted volume 3,000. Actual volume $3,200. Sorry. When I analyze it, it's negative 800 again. Why? Unfavorable condition for Maniel occurs because there are 200 excessive volume stemming from the actual number of plates. Meaning we budgeted 3,000 plates, but we end up producing 3,200 plates. Okay. Since the actual figure exceeds the budget figures, it will also create unfavorable condition, okay, for the expense. Therefore, we are not doing well in terms of food plate production, because even though we sell more, $200 plates, we are selling more, right? In this case, we are. It is costing us negative $800, okay? Why? Because if you go back up, I am sorry. I'm so sorry. Because if we go back up, guys, my cost variance producing a plate is hurting me by 10 cents. Whenever I produce more, I will have to I will have to pay 10 cents more instead of decreasing the cost. That is exactly why unfavorable condition and cost variance is affecting my unfavorable condition for volume variance as well. Meaning selling more, 3,200 to 3,000, selling more is not benefiting me. It is actually costing more. How much? By $800. That is exactly why I have to go back and fix the cost issues in FMB plate production. Okay. When I combine them together, the cost and volume variance, this is the equation right here. Budgeted cost per unit minus actual cost per unit multiplied by budgeted volume and actual volume. So I'm going to plug in numbers just like this when I do the math. Look, it's positive this time, but it's still unfavorable. Why? Interrelationship of cost and volume will tells us how it is unfavorable when two other variances are either favorable or unfavorable. In this case, guys, in this case, if you take a look, in our case, for Manil restaurant, excuse me, both CV and VV are unfavorable, right? Therefore, my CVV will also be unfavorable because in order for us to decide that the interrelationship of CV and VV excuse me, is very important. Okay, so this was the expense side of it. We have one more, and this is the last one, and we only have the labor variance right now, guys. All right, labor variance is slightly different than the cost of goods sold because they are still both expenses. Why COGS and labor variance? Because cost of goods sold and labor variance are the most important expense item for hospitality industries. Okay. We are going to take a look at one more stuff over here because that's why it's slightly different than each other. Okay, we're going to take a look at the efficiency, rate, budget, and the combined variances. Okay, why? Because we have hourly employees. Why? Because we pay them different rates. Why? Because we pay them different salaries. Why? Because we do have the standards in labor in hospitality industries for labor expenses. Hospitality companies, they do have the standards. Standards like what? Standards like, for example, for 10 hours, I need 5 people at $8 per hour rate. That's why, if this is the issue, the entire labor budget variance will be based on the volume variance, the rate variance, the efficiency variance, and the combined RTV variance, okay, which is the rate and time variances, okay. Labor budget variance, volume variance, rate variance, efficiency variance. We have 4, and the other one is the rate and time variance to see if we are paying them an okay amount of money for the time they worked. Okay, Cascades Restaurant is the example. Let's take a look. We have a whole bunch of data in the table. We have budget actual right here. We have number of plates. We have time per plate. We have to train our employees to serve the plate maximum 4 minutes to the end user, which are the consumers. Total time allowed to serve 3,000 plates is 200 hours. Hourly rate we pay $250, and the total cost should be $500. But the actual tells us different. So what we're going to do, we have the actual difference, and then we have to calculate the variances. There is one more information we have to utilize in this question, guys. Allowable time, this is the standard time. For the actual output for restaurant staff to perform actual work is calculated as 213.33. So look, we budgeted 200 hours to serve 3,000 plates. Actually, they took 266.67 hours to serve 3,200 plates, but actually, we tell them to work maximum 2,300.33 hours. Clearly, there is an idle time over here. Clearly, and there is a variance over here. So that's what we're going to calculate. We are going to see a problem. We are going to go back, train the employees better to fix the problem. Okay, guys? So variable labor budget variance is equal to actual labor cost, budget labor cost. I'm going to utilize the table to plug in numbers. Very easy. 640 minus 500, 140. It is unfavorable. 140. Why? Because actual exceeded the budget again. That's why it is unfavorable. Please, please, please refer to the table. The volume variance. Volume variance, guys, right here. Budgeted time minus allowable time for the actual output. This is 213.33. This is the standard, okay? So, well, sorry, budget rate multiplied by budget time minus allowable time for the actual output. 250 multiplied by 200 minus 213.33. It is negative $33.33. A lot of threes. Cents. Therefore, it is unfavorable again, because actual allowable time for serving the place exceeds the budget. 2.13.33 is higher than 200. Therefore, actual exceeds budget, and it creates an unfavorable condition. Please don't forget to utilize the table to decide this. And of course, you can find the explanations right underneath the solution numbers over here, guys. Okay. Well, how about the rate variance? Rate variance is equal to budgeted time multiplied by budgeted rate minus the actual rate. When I plug in the numbers, 200 multiplied by 22.5 minus 240, it is favorable. Why? Look, actual is less than the budget. So I was planning to pay them 250, but I end up paying them 240. I am saving 10 cents per hour per employee. Therefore, I'm saving $20 from the rate variance. So I'm good at paying them for their work. Okay. The efficiency variance, budget rate multiplied by ATAO, allowable time. By the way, this is the short version of it. This is standard minus actual time. So when I do the math, 133.35, when I plug in the numbers, it's unfavorable because actual work time of 266.67 hours is greater than the allowable work time. Allowable work time is ATAO in the equation. Therefore, it is unfavorable. For the last one, RTV, this is the combined one. Again, we're going to take a look at the relationship of volume, rate, and efficiency this time. So we have volume, rate, and efficiency this time, okay? Take a look at the conditions. RTV is favorable because the other three variances, VV, RV, EV, volume, rate, efficiency, differ, okay? If they differ in terms of their condition, RTV will be favorable. On the contrary, unfavorable conditions occur if the other variances don't differ. For example, VV is U, RV is F, and EV is unfavorable. Therefore, different combinations of favorable and unfavorable for volume, rate, and efficiency produces favorable results, but this is not the case in our example. So again, the interrelationship between, among rate, volume, and the efficiency sets the tone for the RTV. That's how we decided. Well, guys, this is the end of this video for chapter 8. I am hoping that you guys enjoyed it. If you have any questions, please make sure to reach me to ask any questions and to discuss any other thing. But again, what we did so far in this lecture, we talked about budgeting process, we talked about the budgets, we talked about different types of budgets, why do we need them, the purpose of them, and then we analyzed the trends based on the historical data. We come up with the strategies for decision makers to budget the next period results for revenues and expenses, both, okay? And then we analyzed the revenue and expense variances. we compare the actual outputs with the budgeted results, and then we come up with the decision-making strategies. Just like, let's say, remember cost, I talked in this video, we are, whenever we produce more plate, one more plate, it's costing us 10 cents. So we have to go fix it. These are the managerial implications of this variance analysis. I hope you enjoyed the video. Again, please don't forget to check your schedule for deadlines. Please try to stay on top of everything, tests, homework or quizzes or anything that is required in this class. Any questions, again, please do not hesitate to ask me. I wish you a great day or night or evening, and I will see you in the next video. Thanks so much.